Hi, everyone. How are you? Fixed income fanatics from Bob Pacheco. That's a new one. I'll have to use that next time. So, hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. Uh, Give me a thumbs up if you can hear me on today. And thank you very much for joining us for today's very special live. I know some of you already know what's going on. Others will find out in a few minutes. Okay, great. Okay, a few thumbs up, folks, if you can hear me. Otherwise, I'm just going to keep going. So I hope everybody had a good first week back after Labor Day. Some of us feel like we've been back for way more than that. In any case, hi, Finnegan. Hi, Edward. Hi, Carlos. Hi, everyone. Okay, so thanks, everyone, for joining us on this live, special live. It's Friday. What's not to celebrate? So some of you have seen our junior team in the comments section as we've grown. They've helped us out. And primarily it's been Caitlin and Ava, who some of you know. It's actually my daughters. They have their own channel, Your Financial Journey. Sophie has her own channel, Sophie the Scientist, and they help us a lot with the emails that come in, the comments that come through. They pass questions my way. What has been somewhat challenging, as our members know, because we talk about it regularly, is finding somebody that is more senior and who can really kind of take a bit off of my shoulders in terms of all the video requests that you guys come, which we love. Oh, sorry. I always forget. I'm sure some of you have seen it. Here's our front of video disclaimer. Here's our detailed disclaimer. Feel free to pause and read it if you wish. In any case, I always forget that part. So now that we've seen that, where was I? I also need to remind you that this is being recorded. If you don't want anyone to know that you are here, as much as I love your comments, please do not comment, and please do not participate in the chat. If you don't do either of those things, nobody knows you're here. This is being recorded. It is being posted on YouTube, and it will live for as long as this video is on YouTube. So with that in mind, here are the three topics that we'll be covering in today's video because, well, why not, right? So the first is that we are introducing the first very senior member of the Diamond NestEgg team that will be joining us. Some of you have already met him before Labor Day. That's one. Two, we're going to talk about interest rates and the interest rate cut that's basically practically priced into the markets at the moment. Howdy, howdy. And then we will take some Q&A from our members and some of the emails that we've gotten and from our course folks and other emails that have come our way over the past couple of weeks. So those are the three things. So without further ado, I know some of you feel like you already know him because we talk about him a lot on this channel. I would like to introduce all of you to Marcus Lamur, my better half. Marcus Lamur will be joining Diamond NestEgg. Say hi. Marcus Lamur will be joining Diamond NestEgg as a co-founder and president, and he will be helping me out on the channel and in the company. And it's taken a bit of time to convince him, but I think he finally came around to it, I would say. Marcus has about 30 years of experience in banking across Europe, the Middle East, and America. He is Austrian. And what else? His last role was at UBS as the head of legacy corporate banking. And he brings a host of experience to us from private banking, private wealth management, ultra high net worth clients, capital markets, investment banking, you name it, he's been there. So we are it's Lamur time. That's you, Bob. You're just killing it today, Bob. So in any case, this is Marcus. You'll be seeing Marcus more on the channel. He'll be doing more regular market updates, and everything is the same as it always was. It's just going to be better, and there's going to be more of it, essentially. So that about sums it up.
I'll try my best.
So Marcus, you want to say hi, tell them a little bit about
Hi, everyone. No, I think Jen introduced me already. We'll hope to get and looking forward to getting to know everyone.
So. Great. Okay, so like we always do at Diamond NestEgg, we're just going to throw him into the fire. And you can still see Marcus. Marcus is still sitting here on the shelf so that, in case you want to look behind me.
We'll
So
never get rid of that.
in any case, so that was one. Now we're going to move to two, which is the interest rates. And the news has come out in the market today around the jobs report and where rates ended the week. And very interestingly, what has happened the past few times that the Fed has cut rates. What do short-term rates look like? What do long-term rates look like? And on that note, we are going to jump right in. So, Marcus, you're up.
Yeah, thank you again. Thanks, everyone. Thanks for the warm welcome. I'm really looking forward to working with everyone, getting to know everyone, and to answer as many questions as we can. So, quick recap of this week. Those of you who followed the news have seen that the jobs report came out today. It was weak. The US economy created 22,000 new jobs. The expectation was for 75,000. And the market, based on those numbers, now assumes that a rate cut by the Fed at the next meeting is as good as assured. No? And when you look at how Treasuries developed, you see here in Jen's graph that many of you know, everything is down. No? I think we haven't seen such a red picture in a long time, where the yields across the entire spectrum are down, which also means, don't forget, yields down, prices up, that people are buying treasuries. So clearly today, when people saw the employment report, they felt they have to buy treasuries, probably lock in those rates when they're attractive, pushing down the yields, because prices up and yields down. At this point, and thank you to William, I think you sent us an article, I don't know whether you're on or whether you listen to it later, that pointed out that in the international comparison, treasuries are still seen as a safe haven, just for lack of an alternative in a way, because all other countries have their own issues. In some respects, we have our turbulences, other countries are even worse off. So the tenor, the message from the article was, people are still buying treasuries when they go and get stuff. And today, in a way, seems to confirm that. With the yields down everywhere, that means prices are up, people are buying. So if you look at that, looks like the next rate cut is assured. That said, nothing is ever done in life before it happens. The rate cut is only done when the next FOMC meeting happens on September 16 and 17. Everyone expects a rate cut by at least 25 basis points, maybe even by 50 basis points. And then the question is, what then with our treasuries and the yields? And remember, the Fed controls short-term rates only. That's how they regulate it, with an overnight interest rate. The long-term rate is really controlled by the market, by investors like us, by large investors, supply and demand, the expectations of the market for interest rates, unemployment, inflation. And that can sometimes go differently from the short-term rates. And we looked a bit to see what happened the last 3 times that the Fed lowered rates. On this chart, there's a lot of color, but we'll have a quick look. It's kind of interesting, I find, but maybe I've been in finance for too long. You see at the bottom, this white row shows us where rates were before the last the last rate cutting cycle by the Fed started. The rate range was at 5.25 to 5.75. The 1 month was at 5.05%, if you can see it, and the 30-year 3.96. And then the Fed started cutting rates in 3 steps. First, by 550 basis points, then again shortly after by 25 basis points, and then again by 25 basis points. So 1 percentage point overall. There was September to December. Sounds like a long time ago, but it's not so long ago, actually. So if you look at what happened, we show here not the entire range of all treasuries. Jen was blaming me a bit. I had to take out a few or 3 short-time maturities to fit everything on a page so that I can still read the numbers, and they're already small. But yeah, no, what can I do? No, it's there. And you see, as expected, when the Fed cuts rates, the short-term Treasury yields go down. You see it very nicely here. The 1 month went down from 5.05 before the cutting cycle started to 4.44. We won't go through all of them, but you see up to 6 months a year where the numbers are red. With every cutting cycle, the rates went down. So as expected, Fed lowers rates, Treasuries yield less. The surprise is more those green numbers for everything from at least 2 years up. You see here that, to many people's surprise, with every rate cut by the Fed, the yield of long-term Treasuries went really up. So maybe the easiest to see is the 30-year. Now it started at 3.96. Then the Fed cut rate by 50 basis points. It went up to 4.03. They cut another 25 basis points. It went up even more. And then they cut the last time, and it even went up even more. So reminds us, no, it's not unknown, no, it's happened before, that long-term rates, long-term yields are not controlled by the Fed. Now it's really the market. What do people expect for inflation? What do they expect for growth? But the market clearly doesn't tell us why exactly those long-term rates go up. So we'll need to see what happens this time. No? Will people expect that inflation will go up? Will people expect that growth will accelerate after the rate cuts make the economic climate easier? Then we may see rates go up again this time. Or may they expect a worse environment, see Treasuries more as a safe haven, and jump in and buy them, pushing down rates? We'll see. No? We'll only really know after the FOMC meeting in 10 days or so. But of course, now for all of us here, or most of us here who are Treasury investors, bond investors, the question is, if we have spare money, should we invest now, lock in those rates while they are there, or should we wait? Or you will see that later in the questions, should we look at alternatives? Could we get a bit of a higher rate with other alternative investments that are related to bonds, close to bonds, but maybe be paying a bit more? I think that's what we learned so far from this week. Jen, anything to add?
Yeah, there was a question here from Solomon. It ties into what you just said, which is what happens if the CPI shows inflation getting worse next week? So the answer is, we always say nobody has a crystal ball. We don't know. But over the past, I would say, couple of Fed meetings and just the speeches that have been given by different members of the Federal Reserve Board, it seems that the employment situation is a bigger concern than inflation at the moment. They feel that they're close to their target. They're not at their target, but the jobs report is really what kind of keeps them up at night. So of course, that clearly depends on how high inflation will be. So I think the answer is, Solomon, stay tuned for next week's update video. We'll find out, how things go then. So that's that. Now I'd like to just show you that, because this live will replace our weekly update this week. This is what the yield expectations look like on Fidelity for the upcoming week's Treasury auctions. And as I always say, these expected yields can change all the way up to the time of the auction. Who knows what reports will come out next week? These numbers will move with the market. Today, yields are down significantly, so these rates are all down. That said, those of you who've seen our charts on what these numbers have looked like historically, these yields are still really good relative, or pretty good relative, to the 5-year average, the 10-year average, and the 15-year average. So is this a week where I'd be jumping in with, all the money I have? Probably not. Is this something that if you're dollar cost averaging, you would still dollar cost average into? It's still something to consider, given that rates on average are still at quite attractive levels. So that was that. And I think we can now dive into the Q&A, where you will see a host of different topics and alternatives that folks in our community are exploring at the moment. So the first question is from Marcus, who says, welcome, Marcus. Marcus
appreciate that from Marcus to Marcus.
Not mine. So Marcus, who's asking the question, picked up a 7-year MIGA to lock in the good rates. As we've talked about on this channel, annuity rates tend to track long-term interest rates. He wanted to lock in some good rates before the September Fed meeting. And he's trying to figure out essentially from his 7-year MIGA. And here, I guess Fidelity calls it a single premium deferred annuity. That's what SPDA stands for. He wants to figure out what the tax equivalent yield of a 7-year MIGA is to an in-state municipal bond or treasury agency for his tax bracket. Because on Fidelity's tax equivalent yield calculator, they only have a 3-year MIGA or SPDA. So he's asking whether, given these numbers, how he would go about calculating it for his tax bracket. So this is Fidelity's calculator, and I'll let Marcus kind of walk.
Yeah. It gets a bit technical here. There are a lot of numbers, but I think we'll focus on the principles. Ask questions in the comments if you want more of a deep dive. So the basic problem behind Marcus's question is that, as now most of us know, many of us know, bonds of different types are taxed very differently. Treasuries, probably the most popular bond, federally taxable but free from state and local taxes. In-state munis, the interest completely tax-free under some circumstances. Corporate CDs, generally fully taxable. So the rate you see is not necessarily the rate you get in your bank account after taxes. And clearly the after tax is also dependent on how much tax you pay, and which tax bracket you are, where you live. And that's a bit the problem I think the other Marcus is grappling with. And 3-year single premium deferred annuities, or the 7-year version that he's been buying, do offer some attractive rates currently at 4.4%. They lock them in. And a particularly nice feature for these deferred annuities is that you don't pay taxes before they pay out. So essentially they accrue the interest, but you don't pay taxes every year, which gives you a slight advantage over corporates or CDs who have the same basic taxation, but get taxed every time they pay out an interest rate. And I think what Marcus wants to know is that he, I think, understands that the longer you defer your taxes, the more advantageous it can be. Can the difference be so big that the 3-year, the 5-year, and the 7-year deferred annuity, the MIGA or single premium deferred annuity, as Fidelity calls it on the screenshot, would look completely different from what he sees here? And I think the answer, Marcus, now if you hear this, is if you want to do a rough but directionally correct comparison, as you write now, between a deferred annuity, a MIGA, that's the leftmost column here, and a tax-free in-state municipal bond or out-of-state municipal bond or a treasury, which, depending on where you live, may save you state and local taxes. This 3-year single premium rate, this 4.4% that Fidelity gives you here, under the assumptions we put in, is probably directionally correct. If you have a longer one, it may go up by a few basis points, but it wouldn't change the picture overall. Remember now, the main tax savings, when you look at after-tax yield, usually come from differences in taxation. So completely tax-free, clearly more advantageous than just tax deferred. And now fully taxable immediately, probably the worst. That's the main driver. But it's now 3 years, 5 years, 7 years, makes a bit of a difference, but doesn't change the picture. And the other advantage of a deferred annuity is when you buy it now and you only pay taxes when it pays out, and you're in a lower tax bracket when it pays out, that's the main savings you can get from a deferred annuity. You pay it now, maybe you're still working, you would be in a higher tax bracket than when you retire, when you expect maybe less income, or you move to a more tax advantageous state, and then it pays out then. That could be a nice savings. But directionally, to answer the question, those 4% here give you a good orientation if you want to compare it just in principle versus municipal bonds, treasuries, and agencies.
Okay, thanks, Marcus and Marcus. So, Alex, I think, Alex, you've asked us this question 2 or 3 times. I'm sorry, this is just coming through now, but Alex says he's sure he missed it in our excellent videos. Thank you, Alex. But a 1-week delay in auto-rolling T-bills is a big inconvenience for me. My Schwab account has a delay. I wonder which broker does not have this delay. So we know that Treasury Direct does not have this delay, but Treasury Direct is not a broker. So if you buy T-bills, essentially, it doesn't really make any sense to transfer it out to another broker and try to sell it. The only broker that we are aware of that does not have this 1-week delay, and we gave you the short answer to this question, is Fidelity. The thing with Fidelity, though, is there is no delay. There's no delay. So once, say, your 4-week T-bill matured yesterday, it automatically rolls over into the next one. The one issue that a few of us have encountered is that, say, for example, that you buy a $10,000, say that you have a $10,000 4-week T-bill that's auto-rolled every 4 weeks. When it's auto-rolled, that money is deducted from whatever cash that you have in your account. So, for example, if you're buying so if you have, say, $10,000 or $20,000, say you have $20,000 in SPACs as your free cash that you've parked there as dry powder in case the market drops or in case you find a good opportunity. When that 4-week T-bill is auto-rolled, Fidelity will actually take $10,000 out of your $20,000 SPACs balance and use it to fund the next T-bill purchase. And that's how they managed to do it without the gap. So again, if you have a $10,000 face value T-bill a 4-week T-bill that you're auto-rolling, and you have $20,000 spare cash sitting in SPACs or whatever money market fund you've parked it in, Fidelity will basically pull the $10,000 it needs to buy the next T-bill, and you will only have $10,000 of free cash left in SPACs or in whatever money market fund that you've parked. So you won't have the full $20,000 access to you. One way that some folks have gotten around this is to actually put their spare cash in another Fidelity account. So it's very easy to set up another brokerage account with Fidelity. So they would actually move that $20,000 into another Fidelity brokerage account with a different account number and park their spare cash there. And in that way, you can avoid kind of Fidelity taking the $10,000 from the same account to go ahead and purchase the T-bill. And when you think about it, it kind of makes sense, right? Because they do have to kind of pre-fund it for you if they buy the next T-bill for you with no gap. So that's a long-winded answer to your question. So Fidelity is the broker without a gap, but if you have excess cash parked in the same account that you're auto-rolling your T-bill, in the week that it is auto-rolled, that Fidelity will pull that money out of your spare cash. Okay, so Wallace seems to have had the same problem. So that's his description. None of the brokerages do this correctly. The only way to really get around this issue is really to hold it via Treasury Direct, or to move your money, like I said, to another Fidelity brokerage, set up a new brokerage account where you park the excess cash that you have in money market funds. So that's the kind of long-winded answer to Fidelity. And here Clinton says he uses Treasury Direct. So one of the reasons why a lot of people use Treasury Direct, even though they don't love it, is because the auto roll is just so much easier. No extra cash is tied up. But again, if you want to sell it before it matures, you can't really do that with a T-bill at Treasury Direct, because it can take up to 6 to 9 months for them to move it over to a brokerage. By that time, it's already matured. So it doesn't really make sense if if you think you're going to sell it before maturity. So the next question, and just so that all the folks know, the dark yellow slides, we like to get organized here. The dark yellow slides are my questions. The light yellow slides are Marcus's questions. So
strictly divided.
So Nicole, so on our last member live where we introduced Marcus unofficially to our members, we answered a question from Nicole about an investment company called Fundrise. And we answered some questions on hard money lending. So Nicole wanted to follow up, and she wanted to know whether we, Jen and Marcus, would invest in Fundrise and in hard money lending ourselves. So I'm going to hand these two questions over to Marcus.
So maybe a quick intro into Fundrise for those who haven't seen it yet, or who are not familiar with it. It's an asset manager who essentially provides access to private investments. So investments that are not listed on any exchange, that are, if you want, hard to get, for small investment amounts, starting as low as $50 or so. So that's a niche in the markets that's currently growing very fast, very popular. So it makes sense to have a look at it. The promise, of course, or the hope is that private investments return a little bit more than public investments, than listed investments that you can sell every day. But the disadvantage is that you can't sell them necessarily whenever you want it. And that's true for Fundrise funds as well. They are generally, in one way or another, gated. You can't just return them, redeem them every day. You may need to wait for a redemption window that only comes once a quarter. You may have other restrictions on redemptions. That's not unusual, by the way, for private investments. So that's the overall setup. So clearly something maybe worth a look. And how do you evaluate now whether you want to do it? I think the philosophy that we have, that Jen and I have, is that before investing in a private asset that is illiquid, that is a cost. If we need the money, we have to wait. We may not be able to get it sold at all, or we may not get a good price. We always compare it to a comparable listed liquid ETF or fund or direct share that we can buy on the market, where we know what it's worth every day, and that we can sell every day. So in this case, Fundrise does have a growth fund for venture capital, but it's very fresh. What they really made their name with are real estate funds. And they have two of those, the income real estate fund and the real estate interval fund. And with the real estate funds, our baseline for comparison, I took the Vanguard's real estate ETF VNQ. That's the largest real estate ETF in the US by far, 60 billion in assets, 30 basis points expense ratio, so relatively affordable. And it shows 4.14, 4.14% trailing return, total return over 3 years, 6.19% over 5 years. And the distribution yield, now what they pay out every year, the latest on Morningstar was 3.76%. So not bad, but that's the benchmark that essentially Fundrise needs to measure itself against. And if we do that, when you look at the two funds that Fundrise really has in that space, you can see that the top one, the Fundrise Income Real Estate Fund, is something we might potentially consider. The annualized return since inception, 22, maybe 3 years-ish, maybe 4 years-ish, 7.7% is respectable. It's a bit better than what the VNQ would offer you, 4.14 for 3 years, 6.19 over 5 years. So a bit better. So you get a bit of a premium, so maybe something you want to look at. But the main advantage, the main draw of the income real estate fund is the income, as the name says, because they distribute basically what they take in. So the distribution yield, what they pay out, is 7.74%. Basically everything they earn, that's more than Vanguard, which only pays out 3.76%. So something you could look at, you could consider if you're not afraid of the illiquidity, because the Fundrise, as we said, will be difficult to sell if you ever need it outside of a redemption window and whatever other conditions there may be attached. So the other Fundrise fund, the real estate interval fund, is interval means it's another fancy word of saying you can't just redeem it. You need to wait for one of those windows at certain intervals. You can only redeem it. So it's illiquid. And the annualized return over the past, again, 4 or 5 years was 4.4%. That's pretty much the same, maybe a bit less even than Vanguard's real estate ETF. So from my personal perspective, from our perspective, you never know what the future will bring, but the best guess, the best indication you have is from the track record for something that has a total return that is basically in the same range, maybe even slightly lower, depending on how long exactly it is, than a publicly traded fund, and pays out almost nothing, so you don't get cash. We don't see a strong case for investing. So that's nothing we would really consider. Jen, anything to add from?
No, and I think, Nicole, from our perspective, so this is how we would think about it if we were in someone else's shoes. Let's put it that way. Us personally, we wouldn't invest in any of these, not because we don't like them, but because we already own real estate directly. So we wouldn't consider these for our personal portfolio. But for someone who is interested in real estate, you need to factor in return. There's always a reason why you're getting the level of return that you're getting. So you need to think about the illiquid nature of it, because I know that you have been asking about Fundrise for quite some time. Yeah. So the next question that Nicole has is about hard money, private money lending.
Yeah, it's again for all of those who don't know it, who missed the member life, it's similar. Hard money or private money lending is essentially a type of lending where you don't look at the credit worthiness of the borrower, of the person who borrows that money, but you look at whether your loan is secured by a real asset, by a tangible asset. That's why it's called hard money. For security, for safety, you look, is there a hard asset behind it, not just the promise of the person who borrows it. That's something you can do. It's a completely legitimate business. It has two advantages, at least from the perspective of the potential creditor. It goes fast, it's short term, so it's illiquid per se. You can sometimes sell it, but it's relatively liquid. But those hard money loans are only essentially extended for a year or so, sometimes a bit more, sometimes a bit less. But it's a relatively fast moving business, so you should be getting your money back regularly, and it offers higher rates. So sounds interesting. You have a property that secures it. You get the money back after a year or so, let's say. You may not be able to sell it in between, but a year is usually manageable, and you get a good rate. What's not to like? So as always in finance, we always say, Jen says it, high risk, high return. The risk is higher because you essentially have to still hope that the borrower will repay you. If the borrower doesn't repay you, you have to go in, seize that property and sell it. That's if you're in the real estate business, that's probably fine. You know what to do, you know how it works, you know who to talk to. If you're not, that's clearly a big hurdle. And it's also liquid, as I said. It's relatively short term. It should repay after a year if everything goes well. But if you need it in between, it's really illiquid. So that's how you really get the higher rates. It's really that risk that you have to go in, seize a property, sell it if the borrower can't repay it. And don't forget, you don't necessarily have checked what that borrower has in terms of repayment capabilities. So hard money, private money lending, just because sometimes it's confusing, it's the same thing. You lend money, you get a hard collateral, usually a property, a piece of land, a house, whatever, sometimes something that is being renovated. And it's hard money when it's done by an institution. That's usually a tough business, very structured, no exceptions. Or private money lending when it's done by individuals or families. That's sometimes a bit more flexible, a bit more personal, a bit more relationship driven, especially if it's to someone you know. So question again from Nicole was, would we do it? Not us personally and not directly, for the simple reason that this credit risk that it can't be repaid, and you may have to go in and maybe together with other creditors, but you would be involved in seizing a property, selling it. That's nothing we would be comfortable with. That's not our experience. That's not our world. So that's something I wouldn't necessarily do.
Okay. So Marcus, I'm just gonna throw this out there. Bob says that's a different definition of hard money than I'm used to. I know hard money is a lender is personally liable after the sale of the asset creates a deficiency.
Yeah, Bob, that's a very good comment. No? I said, no, as we say, it's primarily the value of the tangible asset. No? So there are two ways. No? Understood. Now the borrower is personally liable.
Okay.
So that depends a bit how you do it. No? In many cases, the borrower will be personally liable for everything that can't be recouped when you have to sell the asset. But as you say, it's the secondary liability. No? It's after the asset. You go for the asset first. And that means now the borrower itself comes only in the second. He may or may not have money, because in real life, what it means if you have it, that, how do we say that nicely? You usually are less diligent when you look at the credit worthiness of the borrower. You usually look at the asset first. You hope you can get your money back from the asset. You don't have to go to the borrower. It just makes it more complex, makes it longer. But he may or may not have, or she may or may not, if it's an institution, the institution may or may not have money. Eh? But yes, there is also a variant where the borrower is responsible for everything that the asset can't do. But every credit risk evaluation is mainly based on the value of the asset, because you hope when it goes down the drain that the asset is worth it. It's a bit like when you take out a mortgage. No? The bank always hopes that you can pay it back, but at the end, what they want to know whether you can. But it's easiest if the house is worth it. I hope, Bob, that answers it. No?
So we have we have from.
But it's a good argument. No?
So we have someone says Grüß to Marcus.
Dankeschön.
And Nicole, to answer your question,
German accent. No?
Nicole, to answer your question, Nicole had a private question about how long it took me to learn German and how long it took our kids. So our kids are actually fluent. They've been speaking German since they were born. They speak to Marcus only in German, and he also only answers in German. They used to try to speak to him in English, and he would pretend that he didn't understand anything. So they've now stuck with German. And for me, German took about 6 months after I moved to Frankfurt for me to fully kind of be a college level German, but it was 6 months, 12 hours a day, 6-7 days a week. And the reason for the aggressive learning was because I was pregnant with Ava at the time, who you guys sometimes now see on your financial journey. So that was an aggressive sort of speed German learning. And my German it's okay. It's okay.
Let's just say it's very good. No, I was initially hoping that me speaking German to the kids would give us a secret language, but no.
No, that doesn't really work because they understand everything we say. So in any case, so let's move on to Sean. Sean wants to know whether it's possible to buy long-term care insurance at 65. So the short answer to this is it is possible, Sean. There's a number of insurance companies that do this. Generally, they are not standalone long-term care insurance policies. And the reason for that, I think I may have mentioned it in one of the videos that we did or one of the lives that we did. The standalone long-term care insurance policies, a lot of companies just don't do them anymore unless you get it through your employer, who then kind of has a group policy. And the reason for that is because a lot of these long-term care insurance companies that issued these solo policies back, a couple of decades ago, they priced it so low that when interest rates moved, they had to increase the premiums. And the folks that bought these long-term care policies basically couldn't afford the premiums. And essentially, long story short, either these folks use it and lose it policies, we call it. They either forfeited their insurance because they couldn't afford the premiums anymore, or some of these long-term care companies that couldn't afford to pay everything out, they went bankrupt. So in recent years, most of the people that buy long-term care insurance outside of their employer, what their employer offers, they buy it either as a long-term care rider on a whole life insurance policy, they buy it as a long-term care rider on an annuity, or they buy long-term care insurance that's coupled with some sort of life insurance. So 65 is not too old. it is somewhere, it is on the older side, but not too old. Usually you'll be able to buy some sort of long life insurance with long-term care or some hybrid long-term care insurance policy up to the age of 69. If you're interested in learning more, shoot us an email, Jennifer@diamondnestegg.com, and we can set you up with our specialist at Mass Mutual who can walk you through everything. Oh, Sean has another question on fractional investing in real estate through DSTs. And I think DSTs are the Delaware Statutory Trusts. Marcus is our real estate guy for the evening. So there you go.
And please not drop a note if we got it wrong, but as Delaware Statutory Trust, that's what I know, it's very similar actually to a private investment fund. It's a private investment in real estate. So it's a statutory trust in Delaware where multiple investors can co-own a piece of real estate, a building, property, real estate, residential, commercial, in fractional ownership. And they're just owners, not just passive owners. Every trust needs a sponsor. It's typically a real estate firm who acquires the property and manages it. So not can feel similar to a fund, the private fund. It's not tradable clearly. No? The advantages gives you direct access to one piece of property or maybe even a small portfolio with smaller amounts because it's fractional, because there's always a sponsor who manages it, similar to a fund. You have no ongoing management duties, so it's often sold as passive income, but so are funds. And one big advantage versus a normal fund, it allows 1031 exchanges, as the taxman calls it, which means that if a Delaware Statutory Trust, if a DST wants to get rid of a property and doesn't want to pay capital gains taxes, they may be able to defer those capital gains taxes by not selling, but exchanging the property against another one of similar value. So that's complex. You need very good professional advice, good lawyers, good tax accountants. But if played well, it can allow you to defer the taxation of capital gains until one day it's really realized in cash and paid out and not exchanged into another property. That's if you want, if you go back to the first or second question, the same advantage you have if you buy a MYGA or a deferred single premium annuity, you pay it in, you really only have to pay taxes at the end when you cash out. That's the big advantage of a Delaware Statutory Trust, especially if you, for example, again, you do it for retirement, you pay it in now, you're in a higher tax bracket when it pays out in the end. If that fits with your timeline, you're in a lower tax bracket. That may lead to real tax savings. It has disadvantages. There's nothing is perfect. Often, not always, but often, usually for accredited investors only, so certain minimum levels. It's private, generally illiquid, hard to sell. So while you can accumulate it, similar to an annuity, it's very attractive, can give you a good return, can defer taxes. But if you need the money before it matures and before it pays out, it can be hard to sell or not easy to sell at a good price. But that's also similar to every fund. You're completely dependent on the sponsor's management and they may charge a high fee. But that's not so different from other funds. So our thoughts, it can make sense as part of a diversified portfolio. If you can live with the illiquidity, if that fits your time horizon, and maybe you even benefit from the deferred taxation of the capital gains via the 1031 exchanges, if that fits with your timelines, and if you find the right property and sponsor. So it's very hard to say in general. That's just a structure, but it makes sense. Really depends on the actual property. And from what I've seen, I've heard, but you need to be careful case by case. Very often DSTs are structure that people use for very high quality properties. Usually it's less diversified than a real fund, but often sponsors put some of their premium price properties in there to have a better control about who participates or not. But again, it's not in every case. You need to look. And as we said before, it's illiquid. It's a real estate. do a benchmarking against a liquid alternative. Again, V&Q, just because it's the largest real estate ETF on the market. We showed you before what you can get there, something like 6%-ish over 10 years. Payout of roughly, I'd say 3.78, I think was the latest number. If a statutory trust, it was a past numbers clearly, no? But if a statutory trust has a similar track record and you project for both a similar trajectory, it can make sense to look at it again if you like the property, like the sponsor, and can live with the liquidity. And I assume that's a discussion we'll be having more often as rates go down. How can you get higher rates? You'll have to pay a price, and illiquidity may be a price that you may be willing to pay if you don't need the money, because that's still usually a good tool to get a bit of a higher return, depending on the circumstances.
Okay. So pool mile 30, I know this is not.
Hello, Shadow Guy to Switzerland.
Yeah, so I'm actually surprised how many of you are in the German-speaking countries that are here. It's also pretty late there, isn't it? But I guess it is Friday evening. But in any case, Pool Mile 30 wants to talk about I-bonds. And he wants to know if he can deliver a gift I-bond, is what I read into this message. If it was originally purchased at a face value of $10,000, but now interest has accumulated. So can he deliver the full amount? So based on our conversation with Treasury Direct, and this was, if I have to venture a guess, it must have been a year ago or more. What they had told us at that time was that you can deliver the $10,000 face value to your recipient without including any accumulated interest. So the 10,000 limit is on the face value. I have not heard any issues of folks delivering I-bonds that have a $10,000 face value plus more with the accumulated interest since then. But if you want to be 100% certain, I would suggest calling them. They're very easy to get through to now. Not much of a wait time, but from what we understood, like I said, a year plus ago, was that you can deliver the $10,000 face value plus any accumulated interest to your recipient, so long as they haven't purchased any I-bonds this year, without any penalty. So, but if you do want to be completely 100% sure, please do give them a call. And I think there was a question, it's not on here, but there was a question, there have been a few questions about the fixed rate on the I-bond. We haven't done the number. Well, the numbers will change until probably end of October for the November 1st fixed rate. But in all likelihood, based on where TIPS yields have been trending, it will be likely lower than where it is now. And the overall composite rate will also be roughly lower based on what we've seen with where the inflation numbers have been the past couple of months. But we will do an updated video on that closer to the time that the inflation numbers are released and before November 1st in any case. Oh. Okay, so Dave A has a question about preferred stocks. We talked about this in the August member live as well. He got his first monthly dividend from PFF. I think, Marcus, you had mentioned PFF. And he says, thank you. Its P ratio, price to earnings ratio, is 3.91 on Yahoo Finance. Seems extremely low. Any thoughts? And the second question was about doing a segment on how to track imputed interest on strips on Treasury zeros. On the second question, I'll answer that because it's easy. Noted. We'll look into that. But I'll let Marcus answer your question on PFF.
Yeah. So on PFF, in a way, if we go to the next slide, Jen.
Okay.
Maybe first the baseline. So without preferred shares, I think many of you will know, but just it's a hybrid. Now it's essentially technically a share, but in many respects it behaves like a bond. So bond-like is a fixed coupon. A preferred share will say 6%, 8%, 7%, whatever. That's essentially the percent it pays out. It does normally not vote in shareholder meetings. And it's preferred, not in the sense that gives you more security generally, as some people hope, but only preferred in the sense that if everything goes down the drain, in the case of a liquidation, it pays out before regular equity. So really a share that pretends to be a bond by paying a fixed coupon. But because it's really a share, it has some equity-like features. For example, it has no maturity and no fixed repayment. So in a way, it's like a perpetual loan almost. The company can skip dividends, even for preferred shares. We all know normal dividends, companies can skip if times are bad. They can do that for preferred shares as well, even though it's a guaranteed amount. But on the positive side, also equity-like, if some conditions are met, many preferred shares have dividends that qualify for tax purposes, which is like tax speak for you pay capital gains taxes, which depending on where you are in the tax bracket can give you significant tax savings. So depending on exactly where you fall, but now you can go down to a much, much lower highest rate. You can almost save half of taxes. So that's the advantage. Essentially less guarantees than for a bond, because you can skip them, but better tax treatment and in a way a bit more flexibility sometimes. And preferred shares, by the way, that's what I described, is the basic idea. They come in many flavors. Some are convertible, some are cumulative, many are callable, because normally there is no repayment, no maturity. So most companies tend to make them callable so that at some point they can also repay them and get them out of the picture if they want to. So that's what it is. PFF is, I think, the market dominant preferred share ETF. It is 14 billion preferred stock from generally good companies. Their top three holdings are Boeing, Wells Fargo, KKR. And if you go to their own website or to Morningstar, it shows you an SEC yield of 6.3% per end of July. That's a distribution yield, not a percentage that essentially should be paid out to shareholders. And the total return, so that's the total return, what gets paid out, plus the development of the share price, so plus any capital gains or losses, per end of July of 5.5%. It's a bit lower because the share went down a bit. So those are pretty good numbers for an instrument that is in some ways often seen as an alternative to bonds. But Dave clearly went on Yahoo Finance and they showed a price earnings ratio of only 3.91%, which is a bit low. And just to answer it simply, the reason really is that preferred shares are not really shares. Measurements like the price earnings ratio have really been developed for equity that is real equity, real shares, that participate fully in the gains and losses of a company. Preferred shares don't do that. They generally pay a normal dividend, almost like a bond of a certain percentage. So the measurements don't work. And just to show you how, almost like funnily surreal it gets, the standard measurement of a PE ratio is that you essentially, as earnings, you take all the earnings that are attributable, that could be distributed to shareholders. Preferred dividends are not distributable to shareholders, so they get deducted from that number. So if you tried it in your head, a price earnings ratio on a preferred, when what gets paid out to you as the holder of a preferred is actually not included, it makes no sense. So what most people do when they own an ETF that holds underlying assets that are bonds or preferred shares or commodities or real estate, anything essentially that's not a normal share, people tend to not look at the price earnings ratio that Yahoo Finance shows. It just makes no sense. It can be misleading. It can be right, it can be not. You just never know. So what I personally do when I go to ETFs that hold bonds or preferred shares or anything else, I go to either the website of the fund management company or Morningstar if you want a neutral website, and look at the standard measurements for funds and ETFs that they show, like what I show here, what we show here, the SEC yield for distributions, maybe the Morningstar TTM distribution yield as an alternative, and the total return that is again shown on Morningstar or on the fund manager's website. And that will generally give you a more accurate picture of how such an ETF develops and performs, historically speaking. I hope that answers the question.
So Marcus.
Thanks, Sean. Thanks, George and Sean.
Sonky is a question about the dividends considered capital gains?
Yeah. So I can't confirm that. No? The only one who can really confirm that is the IRS, no? So the taxman. But as to my knowledge, in the past, it has generally been recognized as qualified dividends. No? So technically, they're not capital gains; they're qualified dividends and taxed at capital gains rates.
So Sean,
but again, the taxman decides. No? So it's a bit like our general past performance is not indicative of future results, but yeah, generally it is.
So Sean speaks very good. Either Sean is Google translating or Sean speaks very, very good, very, very good German.
Yeah. Well, thanks for the compliment, Sean.
So Sean basically said that Marcus is a very he has
good partner for the community.
A good partner for us. Okay, so some of you may remember this Vanguard video. This is really for Vanguard folks, yeah? Where Vanguard had a message that said starting mid-September, they were going to require 10,000 minimum purchase requirement on all bonds. And the message they had on there was all corporates, munis, agencies, well, all bonds essentially, except secondary market, including, all bonds and secondary market CDs. And then we had called them to confirm, and they said the new issue treasuries would not be subject to this minimum. And that was the video we did on that. And you guys can watch it if you want, but essentially there was a whole host of reasons why they were going to implement this, from cost cutting to basically streamlining their processes. What happened after we posted that video, a lot of you were very unhappy with a lot of stuff. Let's put it that way. But then I think we posted it on a Tuesday, Wednesday. On Friday, the message on Vanguard's website disappeared about this minimum. And it seems that it's not happening now. Howard has emailed us twice. We have posted an update on a written post to let everyone know, but just so that all of you know, once again, here, Howard, thank you for sending the email three times. Just so that everybody knows, it seems that Vanguard has reversed their decision. There was no formal notification. It just disappeared from the Find Bonds and CD screen. From what I saw today, there was nothing there. I tried to buy something for $1,000 for $1,000 face value, and it seemed to have been fine. But again, it's only September 5th, and I think they had said originally that they were going to implement it, I think this weekend or next weekend. I can't remember anymore. But in any case, it seems that this is not happening. We will reach out to them and try to find out what the situation is and what the story is. And so look out for that. But for the time being, that message is gone. And our final question of the evening is from Richard. He's been having his broker take his taxes out of his RMDs for his IRA, and having the broker basically pay to the IRS. And he understands it may be better off taking the full RMD and paying the taxes out of his own cash and checking account. Is that true? So as we always say here, everyone's financial journey is different. This is very much, Richard, similar to, for those of us who own homes, putting your taxes in an escrow account, right? Richard, if you can manage your own money, if you take out your RMD and you say, okay, I'm going to put X amount for taxes aside and roll it over in T-bills or put it in a high yield savings account and basically reserve that amount at the end of the year so that I know that when the tax man calls, I have that money there to pay my taxes, then yeah, why not? You can do it on your own and you can earn that interest on that cash that's sitting in your account, right? If on the other hand, you are going to take all your RMDs and you're going to spend everything and the tax man comes at the end of the year and you haven't saved anything up for taxes, and now you're going to have to dig into your pockets to pay for it, then it's probably a better idea to have your broker take the taxes out, just so that you have that payment and you don't have to shell it out on your own. But again, so this is really a matter of discipline. Some people like having their taxes in escrow and not having to deal with it. Others, like us, we roll it in T-bills, we put it in high yield savings accounts, and we earn that extra interest. And the year we know that the amount is there, so we earn the interest instead of the broker earning the interest, or the escrow account holder earning the interest. So it's really a matter of preference. So that, I think, ends the pre-submitted questions, Marcus. I think we answered quite a few of. There's a request for the tip story.
Oh,
yeah. let's go through the questions.
Yeah.
This inflation, the CPI one we answered earlier. There was a question. Okay, so Dwight wants to know: does the same increase in interest rates historically occur with agency bonds? Do you want to take this, or should I? Or
I can't. The answer is simply we don't know. No, we haven't checked.
Well, that was easy. But we don't know. I think the only thing I would say is, generally speaking,
I would assume.
We would assume so, because agency bonds tend to track. Well, all bonds tend to track Treasury rates, so it should move along a similar path. But we can't confirm it because we didn't look at the.
There may be other factors in play.
Yeah.
It's a bit like the qualified dividend story. No? We can give a general outlook, but we would need to really dig deeper.
So this is back to, I think it was Alex's question about the auto roll on Fidelity. Like I said, Lisa, we spoke about this a while ago. If you set up a separate account where you put your spare cash in to it, so any excess cash, so basically you have one account where you auto roll your T-bills and another account. Well, it works now. I don't know if it's going to work after this live goes out, but essentially, if you basically sequester your funds separately, the ones that you want parked in a money market fund, then you can sort of get around the part where Fidelity takes money out of your money market funds to lock them up to buy the next T-bill. So a number of people have had the same issue. There was one question here. Okay, I think so. Spring Rubber has another private REIT in Atlanta that does the same. Okay, so you guys can read about that. Roots. So Clint says, don't forget that withholding is treated as equal installments throughout the year, regardless of timing. Well, if you do estimated taxes, you have to get the quarterly timing correct. So that's something else to consider. So the tip story, I'm going to let Marcus, I'm going to say that it's something that we agree to disagree on.
I stand my ground here.
So he still thinks it's one of his best investments ever. I agreed to disagree with that. So, and for all of you who are with E-Trade, you should know that Marcus actually loves E-Trade. So that's
it's not easy to use sometimes.
It's
but
not.
When you go into the screens, the actual trading screens are kind of nice, no? But everyone's journey is different. I'm not trying to make converts,
Okay, so in any case, that's Marcus. We'll have a video out this week. I think, I'll be doing the video this weekend, and then Marcus will be doing his solo debut next week. So be kind to him. I'm sure all of you will. And if you have any other questions, as usual, send them our way. I hope you enjoyed today's live. Look forward to bigger and better things at Diamond NestEgg. Thank you for everything. All right. Take care, everyone. Have a great, great weekend. Enjoy. Shadow Guy has one last comment. U.S. expats, Fidelity, and Vanguard won't open an account for you, but Interactive Brokers and Schwab will. Not sure about E-Trade. So I don't know about E-Trade either, but there are definitely restrictions when you don't live in the U.S. All right. You're welcome, everyone. Take care. We'll see you again soon.
Thanks, everyone.
Bye. Have a great weekend.